Good morning, traders. Today is January 21st. This is Brad Matheny. Yes, I have a little hoarse throat this morning, probably from all the crazy rain out here in California we've had. Okay, this is the MENT Rotational Modeling System and Real Estate Update. Want to let you know that Realtor.com has failed to update their database, the one file that I use on the website. They normally update it weekly. I think that we should hopefully get an update this week. Haven't seen an update for the last couple of weeks, but obviously without data, I can't update anything without making things up. So we're going to look at the rotational modeling system and try to focus on what's going on with the modeling system. So generally the way my analysis works is in two forms. You're a trader or an investor or both. You are trying to navigate the markets. You want to understand what's going on. I'm here to try to help. At least that's what I'm attempting to do for you. Now, the way I look at helping you out is there's two methods that you need to understand regarding allocating your money. So number one, you have money in some sort of retirement account normally. An IRA, a 401k, something that is your primary investment capital. And that's going to be for your retirement. Now, you may also have money in a trading account, or you may be trying to trade your 401k. And you could probably do that through certain types of IRAs and others. But I need you to understand the way I present my analysis is in two forms. Number one, the rotational modeling systems triggers on this page are primarily for your 401k and retirement account. It is a rotational system. It's technically always in the market, either bullish or bearish, and you can see we run it in two forms, weekly and daily, and then that nets us into a one account position, which is where we're at today. 50% bearish and 50% cash. Okay, now the other money that you have for trading should be a much smaller portion than you have for your retirement account. So hypothetically, you may have $1 million in your retirement account, and you may only have 100 or 200 grand in your trading account. And that trading account is allocated using this model. So in this scenario, we're 20% stocks, 55% cash, 25% metals, 0% bonds. This is your trading allocation, and I may have to change this so you can understand it, but understand that there's the way this works with MENT.com is you have the broad retirement 401k allocation, which is handled through the rotational modeling systems, deployment of capital, where it's either all in bearish, all in bullish, or in some form of bullish bearish mode like this is right here, and some of it cash. And then you have what's called the trading account allocation, which is designed to allow you to keep trading, to take advantage of market trends, to be aware of where opportunity is, and use these allocations to protect your capital. By moving our capital away from stock trading over the last 12, 15 months, we've been able to securely attempt to try to trade some opportunities that are occurring in the market, but by hedging our money into metals and cash, while the dollar's gone up and the stock markets have fallen, and moving ourselves away from these risky market trends, we've been able to secure and protect our capital much more efficiently than had we left our allocations alone back at 85% into stocks, maybe 5-10% into cash, and 10 or 15% into metals. So understand that this is a game of reading the markets, learning when opportunity is there, deploying capital efficiently to trade when opportunity is there, and then moving capital away from risks when opportunity is not there. And that's really what I'm trying to help you do. When the markets move away from the consolidation phase that's currently taking place and move back into an opportunity mode, we're going to see these levels change. The MENT Rotational Modeling System will likely turn back into bullish. We are going to see this allocate back into 100% bullish trending. We're going to get probably into a 100% long position for our retirement account. That means that, scooping up the SPY and the value stocks and the Dow Jones stocks and indices so that we can ride this forward. Meanwhile, we will move our stock allocation higher and pull more capital out of cash as we see this start to trend higher. We're getting bullish triggers now that are showing up, which haven't been there for the past 7, 8, 9, 10 months, but we're not in a confirmed uptrend. Yes, you could get a little more aggressive and try to buy into this dip right now, as I believe we're going to start some sort of a melt-up trend. But I believe we're going to have plenty of opportunity over the next 5, 6 months to be able to buy into dips and see confirmation ahead of the next big trend, which is going to start later in 2023 and through 2024, 25, 26. So be aware, we have plenty of time to catch these trends. And as I just went through the TT scanner hot list, pay attention to that video. Go watch the TT scanner video. There's information there I need you to be aware of. We're just, right now, the best scenario is batten down the hatches, stay protected, wait for the market to give us a clear directional trend, and then we can start deploying capital. We are not out of the woods yet with regards to the volatility and the basing that's taking place in the markets. So be aware. We need to kind of just wait this out, and you may be anxious and say, well, Brad, I really want to get into this, or I really want to get into that. Follow my advice, stay safely protected, wait for the market to tell us what it's going to do, because we are apexing in a broad scoping. In fact, let me show you here. We're apexing into this pattern, this blue apex right here. We're apexing into this consolidation. We've got a very clear 1, 2, 3, 4, 5 downward cycle phase. We've got a potential ABC move here with a very strong correction. We could see it, and I believe it's going to move back to the upside over here in a C move, and then consolidate back over here, and then get a D move up to potentially new highs, which is where it will stall. Watch last week's video very clearly about this. But long and short of it, ladies and gentlemen, we are stalling in this apex. This is going to potentially see some very big volatility. We might see a bit of a blip to the downside, maybe back down here to 38, 32 or so, back down into this support level. And I will try to extend that. Is that a Fibonacci level? Maybe. So I can't, yeah, that is a Fibonacci level. So again, we could come back down into this 38, 32 level on this volatility before we attempt to revert back to the upside. This is not the time to be jumping in head first and trying to get into some trend that you believe is going to happen. We are not out of the woods yet. We need to move through the next 3, 4 weeks, see what's going to happen, break through this apex, wait for confirmation, and then we can start to trade maybe the 14, 15% upside move or the potential new downside move as it comes. Okay, so the rotational modeling system is currently bearish, 50% allocation, cash 50% allocation, trading account allocation, 20% stocks, 55% cash, 25% metals unchanged. The only thing that changed this week is gold turned bullish on the weekly chart. I think gold is going to stall out probably over the next week or two, maybe 3, and then attempt to move higher. We still have a big move in gold and silver. Could continue up another 12, 15%, maybe more. But again, pay attention. Things are starting to change here. Alternate allocation is 20% stocks, 80% cash. Remember, this stock allocation you have here, whatever you're allocating into stocks, should be broken into 10 or 20 trading slots. Those are for individual trades. So when you have this allocation of 80-20, you should, if your account is $100,000, you should have 80 grand sitting in cash, 20 grand allocated for trading, and that 20 grand should be broken into 10 or 20 trading slots, allowing you to take 10 or 20 individual trades. Okay, this gives you the ability to still trade, but you're trading with smaller amounts of capital, and that gives you the ability to allocate funds efficiently and handle risk efficiently. Okay, the MENT Rotational Modeling results. had a pretty good end of the year. I mean, we almost hit new all-time highs up here. Quarterly, we came out of last year very strong with a couple of strong quarters. And then you can see the end of year, we were minus 0.60. So the rotational modeling system is doing extremely well overall. Wait till you see what some of these larger funds have done at the end of the year last year. It's going to be historically funny to watch these minus 40, 50% drawdowns. The real estate market, like I said, hasn't been updated since the beginning of this month. Looking to get the update. I believe the market is really starting to stack up with regards to inventory. We're getting some mixed results. Interest rates had come down a little bit. We did see some buyers buying into certain areas. Like I've heard that San Diego's hot and Phoenix is hot, meaning that they're not seeing big price declines. But I also know that, you know, other areas like Vegas and other areas have really started to weaken. I think the Fed is determined to burst this bubble. So I do believe we're going to see a downward cycle trend in real estate. I think we just haven't seen that happen yet. I believe the Fed is going to do what's necessary to burst it and move downward. Where you can see that the active real estate listings has been moving higher. Price reductions have been moving higher. New listing counts have been moving higher. Price trends had flattened out. I'm looking for a real kind of a moderate 10-15% drop over the next year or two. And that could continue for a while. But then we have the heat map is weaker. The tightness is back to near zero, which is, you can see it's kind of consolidated here and then broke downward. This means that things got, you know, very loose for a while. That means that the markets were stalling, not really doing anything. Inventory value got very weak for a while, lining up with this weakness over here. It had kind of strengthened back out. And then you see seller desperation here has kind of tanked, meaning that they were not very desperate. And that's coming from the guys here that we had a flu of activity. And it's very interesting. You see this spike in activity and spike in activity. This means that sellers are getting desperate up here. This means sellers are not desperate. So you can see here that sellers were not that desperate moving into the end of the year and beginning of January 2023. I think once the data posts, we're going to see this actually flatten back out. I think inventory strength is going to weaken a little bit. I think tightness is going to weaken a little bit, and I think the heat rank is going to weaken a bit further as well. Okay, well that's, I believe, oh, we got more. Okay, so the U.S. stock market index is basing and bottoming. You can see the flagging formation here again off of these lows on this upward pitchfork channel. We're really at a kind of a make or break scenario. We got above this high last week. We're down below, not below it, but we've had some weakness out over here. I would not be surprised to see some extra volatility over the next week or two with the Fed, with meeting the World Economic Forum, and with earnings still coming out. I think it's going to resolve itself to the upside. Like I said, I think we've extended this deep bottoming phase. You can see the wave count. A, B, C to a low, and then back up to a high, then A, B, C to a low, then back up to a high, then A, B, C to a low. I think this is basically 1, 2, 3, 4, 5, basing bottoming. Now we've kind of seen this A, B, C move. We could see a bit of a rotation back down over here, but I think this is going to resolve to the upside in a melt-up trend, basically being an A, B, C, because this is lining up right here as a double bottom, and then we could see this go D, so we go A, B, C, D, E, up into this area. And that's kind of what I think is really going to take place through the rest of this year. And that's the end of this chart. Okay, guys, big changes coming to the website. Lots of information coming. I want you to be aware of what I'm doing for you and how I'm helping you. We've been doing this. I've been doing this now for almost 4 years, believe it or not. And I continue to make improvements. And I think if you're following me and you're following my research, you see what I'm doing for you, and you see how valuable this information is. Hopefully, because that's my goal, is to keep you informed, tell you what's going on, and guide you through these big market trends. All right, guys, talk to you soon.